Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. Make sure you ring the notification bell to get notified each time a video comes out. I recently had an opportunity to create an introductory presentation about personal finance for 14 and 15-year-olds, and I presented it to the teens in the neighborhood and one whose dad is in my Edmonton Investing Mastermind group. The formula for financial independence and success that I presented is earn money, spend less than you earn, invest the rest, and don't get into debt. And I split the video along these lines. This is part 3, don't get into debt. Don't get into debt, although some people think that all debt is bad, while some differentiate between good and bad debt. The previous installments of the presentation are in the links in the upper right. Don't get into debt. Debt is when you borrow money that you don't have and you pay somebody else interest, or you're renting for using their money. Decide for yourself about good debt versus bad debt. So good debt is when you borrow in order to make more money off of that borrowed money. The money usually gets invested, whether you buy a real estate property where somebody pays you rent, or use the money to invest in other vehicles. You generally want it to be low interest rate, and investments that you put that money into need to make more money than the interest, and preferably more. Okay, you can also use a debt to buy a house when you get a mortgage in order to buy a home. Mortgage is debt. Bad debt, it would generally be high interest consumer debt. You borrow to go on vacation or to buy, a pair of jeans, whatever. You need to decide whether you're comfortable with good debt or whether to avoid all debt. I would definitely suggest to avoid the bad debt. Credit score is something that there's 2 different companies in Canada, and there's 3 in the US. The Canadian ones, basically, they keep a record of how you are with credit, meaning loans. Whether you are somebody who pays back their debts or somebody who doesn't. And it comes to a number. It's good to be aware of what feeds into that number, because I would see that the mobile plan company like Rogers checked what my credit score was before they gave me a phone plan. Some employers, especially if you work for a bank or a financial institution, will check what your credit score is to see how you're with money. If you went bankrupt, bankruptcy means that you basically said, okay, I can't pay my debts, I give up, and all the people that loaned you money get zero or get a very small percentage of the money that they loaned you, they get back. So when you have a bankruptcy, then your credit score is bad. So credit score, it reflects how likely you are to repay borrowed money or meet financial obligations. Lenders are going to use the credit scores to assess the risk of lending to you and what interest rate you'll get when borrowing. So if you have good credit score, you can get debt with lower interest. So maybe instead of getting a 6% mortgage, they'll give you a 5% mortgage, because they feel a lot better that they're going to get their money back. You're therefore lower risk, and therefore the bank doesn't need to be to get as much compensation for lending you money. Lenders report their experiences with you to a credit agency, which I mentioned there's 2. There's Equifax and TransUnion in Canada. So here's what determines what your credit score is. 10% is the number of credit inquiries. So if you suddenly got a couple of new credit cards, if you also went shopping for mortgages, they will see that you're shopping for credit, and that reflects badly on you, because you're probably in money trouble, or you want to go to Las Vegas and gamble, who knows. It's only 10%, but basically if you are going to go shopping for mortgages or for credit cards, apply within a 2-week period, because then you only get hit once with the credit inquiries, and it's only 10%. Credit mix. So this is if you have different types of loans. So if you have a mortgage, you have a credit card, you have a line of credit, and you have a car loan. Okay, if you have a good mix, you get a better rating in the credit mix. Do not get a bunch of loans just for this. That's dumb. Get whatever you would need. Like I have 4 credit cards. It's probably 2 or 3 credit cards too many. But because they're all the same type, it does not improve this. But if I were to get a car loan, then I would get a better rating with the credit mix. Credit history. So this is basically the length and the age of your profile. I got my first credit card when I was 18, so I have a long credit history. It's just a number of years here, and it's only 15%. Interestingly enough, credit ratings prefer for you to have a bad history rather than none, because a bad history, they know what to expect. But if you don't have any history at all, they're like, yeah, that could be really bad. They can use their imagination. And so chat with your parents about getting credit cards in order to get that clock ticking. But we'll talk about credit cards and the dangers of credit cards. Credit utilization. For every loan, you have an amount that you can borrow. So like on a credit card, you might get, when you're starting out, you might get like a $2,000 limit. That's all you can spend on that credit card. If you have a line of credit, which is another type of loan, let's say that one is $5,000. So you have $7,000 worth of credit total. The credit utilization checks what percentage of that 7,000 you're using. So if you have $500 on your credit card, you're using a very small percentage. If you've maxed both of them out, then your credit utilization is going to take a hit on your credit rating. And then lastly, payment history. Do you pay your bills on time? And that's a whopping 35%. Okay? So to have a good credit rating is start using credit responsibly, and paying your bills and your credit cards and everything else on time. That's how you get a good credit. This is what this website is called, Borrowell. This is what I use. It's free. They try to sell you stuff, but so 900 is the best score. Mine is or at least back in 2022 was 841. And the stuff they look for: missed payments, credit utilization, like we just talked about. It was 22% at that point. I wonder what I had borrowed for. Derogatory remarks would be bad feedback from lenders. So if I had paid a credit card late, there would be a derogatory remark. Average credit age for me was 9 years. How many accounts do I have? And here's the credit inquiries. If somebody checks on your credit, I must have been shopping around for a mortgage or something, because I had 3. Everybody kind of see if you have a good credit score, okay, and here's, do I have a good credit score? I was 841, so that's in the excellent range. I'm not bragging, because it's not a brag. Average Canadian is 672, so you're in the fair area. The average Canadian is going to be charged higher interest on their loans, or they might be rejected for a loan. So try to keep it in the good or excellent category. Okay, cars. Who here is planning to have a car? Remember, you're getting this from a guy who's never owned a car, so I'm probably a little too far to one side, but the information here is, I think, going to be useful. Cars depreciate. On the average, a new car depreciates, meaning goes down in value, 20% in the first year, some of them 20% as soon as you drive it off the lot, and then 10 to 15% per year in the next 4 years. By the end of the 5 years, most vehicles are worth about half of their original price. This is new cars. If you borrowed to buy a new car, the chances are very good that you owe more on your car than you could get for it if you sold it. Cars are not investments. Their value comes from use and saving you time. Okay? Unless you own a classic, 1965 Mustang or something, that goes up in value. Everything else goes down. If you don't drive it very much, it goes down less, but it still goes down. My suggestion would be, don't drive your wealth around. Now, I know cars are an emotional thing. To you guys, it probably means freedom. It means that you're going to get a better partner, maybe a nicer girlfriend. Some of you will compare yourselves to friends, and it's like, oh my God, one of my friends would get a new truck and would sit me in it, and it's like, look, the seats they heat up, or in the summer they cool down. And I'm just like, hey, when I'm biking, I just open up my jacket, or I close my jacket. That's how I control my temperature. To each their own. But I also know people who put every dollar that they have into their car, and they're driving their wealth around, and it's going down in value. A car's value is in the time saving. I mentioned that. Your time is not worth zero, by the way. So like me, if I'm going downtown, it takes me an hour and a half by bike, and sometimes I treat myself and it takes me 45 minutes by transit. If you were to drive, I don't know, 20, 30 minutes maybe, so you would save yourself time, right? And your time is not worth zero. So do consider that you could either be resting or working. There's a 28-3 rule for new cars. If you're buying a new car, you need to put 20% down. It needs to be paid off in 3 years or less. That's the 3. And the payments should not exceed 8% of your gross monthly income. Otherwise, you're buying more car than you can afford. My suggestion, and experts agree, buy a car that's 3 to 5 years old. It's still in relatively good shape, under warranty, because the warranties go with the car, not with the owner. And you let somebody else take the depreciation hit. Some people will buy a 10-year-old car, and they'll drive it into the ground. Everybody's got their own thing. New cars are just not a way to improve your financial situation. Ideally, buy the car for cash, which, you'd have to save for it. Or if you're going to get a loan, shop around for it. I swear to you, dealerships make more money off of the financing than they do off of the sales of the cars. So shop around. And you can negotiate the interest on the loan if you have a good credit score. So that was another reason to have a good credit score. Negotiate the price. Before you go to a dealership, know what the car is worth based on the age and the mileage. You can look that up. There's websites. Avoid leasing a car. So leasing is basically renting. You're paying for the depreciation. When you lease, you're renting it for a fixed period, you're making monthly payments, and then you're returning it at the end of the lease term without any ownership. You don't have anything at the end, and you didn't build equity, meaning you didn't build value. You have nothing at the end, you basically just keep paying, and usually leases have mileage limits and wear fees. If you're leasing, you're just financing a lifestyle that arguably you can't afford. Financing a car for a lot of people is just affording the monthly payment, unfortunately. The dealers stretch the loan to 7 years in order to lower the payment, but then you just keep paying interest, and there's a lot of payments. So if you buy a car that you can't afford and then you increase the length of the loan just to be able to afford the payments, you're making a bad financial decision. Okay, we'll just finish off with cars. Key questions to ask before signing a car deal. What's the final out of the door price, including all the fees and all the charges? The dealers tend to be unscrupulous, and they will add additional payments, floorboard fee. I don't know, like they just make something up. They don't talk to you about it, and then when they put something in front of you to sign, like there's additional things that weren't discussed. I generally, on any deal, if you charge me something that you didn't disclose to me ahead of time, I'm just like, you need to take that off. I'm not doing this. Are there additional warranties? That's another thing. And protection plans that were added to the deal, and can I get out of them? Because generally they don't add much value and they're just charging you for them. And can I see a breakdown of the final financing terms and monthly payments? Are there prepayment penalties? So if I decide to pay off the loan early, are you gonna charge me a penalty? And can I review all the documents and contracts before signing? Like, I know people go to the dealership, they get all excited, they talk to the salesman and they talk to the manager, and then in the end they put, half an inch worth of paper for you to sign, and people just like, okay, I just want the car, and they just sign, and they might not even know what they're signing. We're going to talk about credit cards. Everybody know the magical little credit cards? Anybody have one? No? Okay. Okay, so debit card, I'll mention debit cards. Credit cards are convenient, but they're dangerous if used badly. So I kind of look at it as a chainsaw or fire or a knife. You can hurt yourself with them, or if you're using them appropriately, they're great tools. So a credit card is debt. You have a credit card company, generally a bank, that is letting you purchase using borrowed money, and then they're expecting you to pay it off. The goal with a credit card, and I'm going to say this multiple times, you have to pay them off every month on time and in full. If you don't think you can do that, I would suggest not getting a credit card and only using a debit card. So credit card means it's debt. Debit card means that it accesses your checking account. So with a debit card, you can generally only use the money that you have in your checking account. So that way it limits you. While with a credit card, they have a credit limit, which I'll show you. If you're paying it off, make sure you're paying it off 2 business days before the due date. I discovered the hard way that if you pay a day late, or there was a weekend and like a long weekend, and basically there weren't 2 business days before when I paid it and when it was due, you would think, well, I'm a day late, they're going to charge me interest just for the 1 day. Nuh-uh. They charge you interest back to the date of the purchase, not the due date. That's one way they'll get you. Credit cards have a thing, there have been studies, I understand. They make you buy more because it's easy and you're not actually losing anything. Or if you're paying with cash, you're losing something and you have a little twinge of pain inside. But with a credit card, you get the piece of plastic back. So you're not losing anything. So it sounds like in psychological studies, they figured out that people using credit cards spend more, which is what they want. So you need to have self-control, I think, with all of this stuff. Be a responsible adult and buy only what you need. I know some credit cards have, or pretty much all of them now, have some sort of points or cash back or something like that, but this is again to make people buy more. You get the points only as a bonus. It's like 1-2% maybe. So it's not a huge amount, but psychologically people end up buying more and spending more. So buy only stuff that you would buy anyway. And if you can't pay for it in cash, don't buy it. It's huge interest if you don't pay your full balance every month. For my credit card, it's 21%. So just to put that in perspective, if you have a savings account, if you have a high interest savings account and you put money into it, they're paying you 3, maybe 4%. If you have a mortgage, that mortgage interest is probably 5 or 6%. Credit card is 21%, and there's some that are higher. The reason is it's unsecured debt, meaning it's really just on your good name. If you don't pay and you tell them, yeah, I'm not paying, the credit card company would have to go to court in order to sell some of your other assets and get their money back. So that's why they're charging you more, because of that extra risk and difficulty. Mortgages have 5 or 6% interest because it's secured by real estate. So if you don't pay, they will sell your house and then get their money back that way. But credit cards are unsecured, which is why they have such high interest. For cash advances, meaning if I go to an ATM, stick my credit card in, and I pull out $50, from that second, they start charging me 23%, which is brutal. Brutal. This is how banks make money, by the way. Statistic. About 90% of Canadian adults have at least one credit card, which is fine. Of those, roughly 46% carry a balance, meaning they don't pay off their balance and they get interest charges. So as of late 2024, the average credit card balance in Canada was around 4,562. So they're paying about $900 in interest on that average balance. So about half of people carry a balance, and the average is $4,600. Those people are living beyond their means. So this is roughly 40% of Canadian adults are carrying a credit card balance. That's why banks make money. So I don't know if you guys can see that. I scanned my Visa statement. So there's a couple of things here. It says new balance is $1,295, and then it says minimum payment is $10. And here's all the transactions. I would suggest when you do get a credit card, read all of the fine print on a contract, and every month that you get a statement, make sure that it is something that you paid for. So Real Canadian Superstore groceries, they show the last month's payment. I went to an A&W. I treated myself to a hamburger with a coupon, I'll have to say. This was an investment club where I bought myself chicken wings. The big item here was house insurance, once a year, $1,000, give or take. And then Walmart, either groceries or something for the dog, both physical and online. This particular card has cashback rewards and then another grocery. Now, down here is the interest rates that I mentioned previously. You always want to see that there's no interest rate charges if you're doing what you're supposed to be doing. But here's the fun part. Reminder, if you only pay the minimum, which is the $10, this will take you 10 years and I can't read it on my screen either. And I think 10 months. What that is basically 130 months. 130 times the $10 will just pay off the balance, which is great, but that's not reality because there's no interest involved in that calculation. So what actually happens is the minimum payments, as soon as I didn't pay the balance that 1 month, if I didn't pay that statement, the minimum payments would very likely jump to $26, and $22 of that would go to the interest at the beginning, and $3 or $4 would go towards the principal. And as you very slowly over the 10 years, as you pay down the principal, you would be paying more towards the principal and less towards the interest. By the end of the 130 months, I would have paid $1,000 or more in interest. And if they can raise the interest rates as well, so it would be more than that. So on $1,300, if you take a long time to pay it, you're paying for it twice. So the dog treats I bought for the dog would end up costing twice what they actually did in a store. Other fun gotchas that they have. There are interest charges on future purchases until the balance is paid in full. Okay, let me say that again. If I owe them money, if I didn't pay off my balance in full, if I make another purchase, that purchase is immediately being charged interest on. You'll note, I'll go back to my statement. So you'll see when this had been posted. The first one was May 21 and the last one was June 13th. And then they asked me to pay it July 4th. So basically there's a grace period. You should know when the cutoff is for each credit card. So it looks like the cutoff here was June 13th. So it'll be July 13th, August 13th. Anything charged after that goes on a next month's statement. It's a little game people play that you get another month before you have to pay for it. And they give you a grace period of 21 days, which is between the 13th and the 4th of the following month. But if you didn't, which is great, like you get $1,000 that you basically get for free, and you don't have to pay for it until later. The thing is, if you don't pay off the full bill, and you make further purchases, that grace period is out the window, and they start charging you interest immediately. So this is a quote from my contract. You'll receive an interest-free grace period, at least 21 days, on new purchases on your card. The red is my highlight. If you pay the outstanding balance owing on your account in full by the due date show on your monthly statement. So if you don't pay it off in time and you make any further purchases, those get charged the 21% immediately, which is brutal. There's also no interest-free grace period on cash advances, balance transfers, or cash-like transactions, and applicable cash advance fees. So if you go to an ATM and you stick the credit card in, the ATM will probably charge you a couple of bucks, and then they start charging you, I think, 23% immediately. Credit cards, if used properly, are great. By the way, if Amazon gets hacked, and something gets charged on your credit card and you look at your statement and you don't recognize it, you can contest it, and at most you're on the hook for $50. If you use your debit card online and that gets hacked, whatever's in your account is theoretically at risk. So credit cards do have benefits, but as you saw the statistic, half of Canadian adults that have credit cards carry a balance. The other thing is you can get a prepaid credit card where you have to stick money into it in order to be able to use it. So that limits your spending, or a debit card, which also limits the spending. And know the cutoff date. Remember, I said June 13th seems to be the cutoff date for my credit card. So you could wait to buy big items until after that date, so you get them on the following month's statement. So you don't have to pay for it for another month. But don't forget about it, because know that the next one is going to be, there's going to be a lot of money on that next statement. This concludes what I think is the most important financial information young people need to learn. If you have any requests on what you would like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.